Welcome, everybody. It's time to start cruising into a better financial future with your host, Kim Cruz. Hey, everybody. Welcome to our newest episode of Cruising into a Better Financial Future with your host, Kim Cruz.
Thank you, Adam. I am Kim Cruz. I am a wife, a mom, a daughter, sister, friend, entrepreneur, and business owner of Cruz Credit Consulting, but not necessarily in that order. I do have over 30 years experience in corporate America, and I have a passion for helping people succeed in all areas of their life. I'm joined, as you know, by my friend Adam Strum, the brains behind this production. He is a former corporate executive, the owner of Financial Rescuers, and co-owner of U.S. Financial Alliance, and a 20-year veteran of helping people get out of debt and improve their financial health. Together, we review our listeners' financial problems and address them with our experience, tips, tricks, and resources of network referrals to help you cruise into a better financial future.
Kim, that was a mouthful.
That was.
I have a Christmas wish to put out there. I want everyone this Christmas to start watching and start learning so that 2021 is the year they take control of their credit and their finances. Now, we're honored today. We're going to be joined by our guest, Tony Paolella, out of Chicago. This gentleman helps entrepreneurs realize their dreams as part of First Savings Bank. He's the director of business development. He's also been in mortgages for a good 20 plus years, has helped many people get their home financed and get into their new home. And we'll be picking his brain a little bit today.
Yes, thank you so much for joining us today, Tony. We're excited to have you here with us.
Well, thanks for having me. I'm super excited to be here.
We're glad to have you. Let me tell you, I've spoken to Tony many, many times, and I go to him with anything go to about financing. He comes to me with anything go to about advertising, and we exchange ideas all the time, and it's just wonderful. He hosts an incredible meeting once a week online because he used to do it in person, but COVID forced it online. And some of the greatest people I've ever gotten to meet have been part of Tony's parties online. That's what they are. They just are parties of people who own businesses or work in very high levels of businesses that want to exchange ideas and want to get together. And I'm thankful for that meeting every week. I love it.
I agree, Adam. It's a fabulous forum. Thank you, Tony, for putting that on, and thank you for inviting us to attend that every week. And you will probably be seeing a few more guests coming out of that networking group. So I'm looking forward to that as well.
Nice. Sounds very exciting. We're happy to have you. And yeah, and it's great because, yeah, doing events in Chicago for the last 3 years, we generally get 300 to 500 people. But with COVID, we've switched online. We'll have like 50 people, have it more of a targeted audience. But it's great because I know, Kim, you're in Southern California. Adam, you're in the Phoenix area, and I'm in Chicago. So it's cool that we get a chance to hang out at least once a week with 50 other friends and swap ideas and have a good old time, you know?
Oh, it's
Yep.
funny of those. You have about 35 regulars and 15 that sort of rotate, and I've been there for about a month at your meetings every week, and I've made at least a dozen new friends. So I have to say thank you. It's been amazing, and the networking that takes place is top notch. I mean, people get a chance to introduce themselves and what they do. So I really wanted to plug that a little bit because it's just a fun time for an hour online every week, and I enjoy it immensely when I'm there.
Yeah, we love having you. Thank you.
All right, so today's news topic. Are you
This is a
guys ready for
doozy.
this? Yeah,
Yeah.
it's a doozy this week.
Yep.
We have a case out of Colorado. Now, this is going to track back to our bankruptcy episode. For those who watched or listened to our bankruptcy episode, you know that there are two types of debt that really never get discharged in bankruptcy, and those are IRS debt
Mhm.
or any government enforced debt, such as IRS, alimony, child support. Those are rarely, if ever, discharged in bankruptcy. And student loan debt, for many, many, many years, has been exempted from being bankrupt.
Mhm.
Well, in the case in Colorado of Navient, the loan holder, versus McDaniely won and was allowed to discharge $200,000 worth of student loan debt in their Chapter 13 bankruptcy.
Wow, that is huge. That is setting a huge precedence.
We sure hope so, because there seems to be no other way to cut the student loan debt crisis. There is more student loan debt out there than credit card debt, and that can crush the economy. Many people may not realize how the whole economic picture works, but in fact, when you have people coming out of college with 200,000 plus in student loan debt, even if they land a really good job starting at $60,000 a year, they're only making half of what they should be because they have to start repaying their student loan. And so it keeps them from realizing the potential of having the kind of money to spend in the economy that they should. And that depresses the economy for everyone else. And so it would be amazing if those people who don't ever see a light at the end of the tunnel were able to get their student loan debt discharged in bankruptcy. Now, it's really important that I mention this, and then we'll all talk about it a teeny bit. But there is a test, a legal standard that is set for discharging student loans in bankruptcy. And that test is called the Brunner test. And the Brunner test is named after the first person, Marie Brunner, who was a plaintiff in a case that set the rules for discharging student loan debt. And there are three qualifying factors. I'm going to read them off, and then I'm going to pass the ball to Tony and then to you, Kim, and let's all discuss this just a little bit. So here are the three things that you must qualify for in order to discharge your student loan debt in a bankruptcy. Number one is you must prove that your current earnings and expenses cannot support the repayment of the loan without jeopardizing your standard of living. The second one is you must prove the situation will continue for a significant portion of the repayment period. And the third is that you must prove that you've made good faith efforts to repay the loan. If you meet all three of those criteria, the judge is supposed to take into consideration that you've met those criteria, and the precedent is that you can, in fact, bankrupt your student loans. So, Tony, can we get your opinion on this?
Yeah, I mean, it's just when you look at the last 20, 30 years, the price of college has just gone up a ridiculous amount. I mean, I think about when I went to school at the University of Illinois and how much it costs to go there. And I had a scholarship, I had some grants, I had some student loans, the rest I paid out of pocket. And it took me a few years afterwards, but I paid it off. But I look at people going to the same school that I went to, and they're spending like 5, 6, 7 times as much money to go to school there now. You know, it's the same school. And I just think it's just really crazy to get these people that get this education, and the debt just gets so insurmountable, and then the job market's not that great either, you know, for new graduates. So I'm thinking, you know, whatever can be done to help alleviate that financial pain and burden from young people finishing school, I'm all for it, you know.
Excellent, excellent. And Kim, I'm sure you have an opinion about this.
Well, as of next fall, I will have 3 boys in college, and right now we have 2, and one is going to a private school. The second one is looking to go to a Cal State school within the next year. He's at a JC right now, started out at a private school in Arizona. And the third one is looking at a private school as well as Cal State school. So he hasn't made his decision yet. But our loans are provided by or handled by Navient as well. And I look at my kids and I hope and pray to God that they will be able to find a job when they get out of college, because the job market right now for these college students, I feel so bad for them. I actually do some work with some interns for one of my other companies that I own and operate. And I interviewed an intern that graduated from Purdue. She cannot find a job, and it's been a year and a half.
That's
So
horrible.
it is. It's really sad, and something has to be done. And we're not advocating that bankruptcy is the ultimate solution for them, but this is a precedent that's being made, and something has to give.
Right. At
Something.
least it becomes an option. It's never
Exactly.
even been on the
Yes.
table as an option.
Right.
Now, to speak to what Tony said, he's so right. And I'm going to combine both of you for this. This is going to be fun. I'm going to go to UC Berkeley,
Mhm.
University of California, state sponsored school, well known throughout the entire country.
Mhm.
The tuition for UC Berkeley in 1982 was $500 a semester. It's now $26,000 a semester.
Mhm. Yep.
Now, other things have risen in price. We all know. You might remember we're all in the same age range. As kids, we'd watch The Price is Right, and they'd give away a brand new Cadillac valued at $4,242. And now that Cadillac is $40,242. But still, that's 4 times as much. That's understandable over 40 years. UC Berkeley has gone up nearly 1,000 times what it used to cost. And I have my beliefs in the reasoning behind this. It's a structural problem. We added a step in between the student and the school, and that step is what caused the rocketing of prices for school loans. Student loans, when Tony took them and when I took them, it was real easy. You went to your bank and your bank gave you a student loan and you paid the school. They paid you and you paid the school. You remember that, Tony? They'd
Yep.
give you a check and it was up to you to go to the bursar's office and pay the school.
Yep.
Mhm.
That doesn't happen anymore. Now you go to Navient or one of these wonderful student loan agencies that have been set up and have government approval. Sally Mae is another one that actually handles student loans. And they don't give you the money. They send the money directly to the school. So you
Right.
don't even get to see the money you've borrowed, but you owe it no matter what happens. You have to pay it back. So
Correct.
even if the school doesn't provide you the education you're paying for, you're still on the hook for the loan.
Mhm.
It's insane.
And
It's
Yep.
insane. I roll my eyes like that on a regular basis over this stuff.
there's the FAFSA form that you fill out, and we've done it
Mhm.
3 times now with our
So
sons.
you're an expert.
And yep. Need any questions about the FAFSA? Contact me up here. I can definitely give you some pointers on how to fill that out. But so different from when I went to school, and I went to that private school out in the hood called USC, and at that time,
Oh, that's
it
not a
was
school.
hey now. At
I'm one to
that
talk.
time,
I went to Brooklyn College, okay? So
it was $400 a unit, and every class was 4 units. So that was back in the late 80s. And at that time it was, oh, just take out a student loan and you'll pay it off. You'll pay $100 a month. And yeah, we paid off $100 a month for forever. But
sure, because
now,
there's a 6% statutory interest
Mhm.
rate on student
Mhm.
loans, which means if you're only paying $100, only $71 of that $100 is going toward the loan. 39 is going to Navient or whoever the broker for your student loan was. And it's a lose-lose proposition.
Yep. So it takes forever to pay those off. But when you are graduating nowadays and you get your diploma and you're smacked in the face with a $200,000 loan, it's a little overwhelming.
Well, I want to take a moment now. I want to say thank you to the people who have been watching us on our new YouTube channel, Cruising into a Better Financial Future, and sending in your questions to our email at questions@cruisingintoabetterfinancialfuture.com. We've gotten lots of questions, and we were able to pick out 5 really good ones for our guest, Tony, to help us answer. But before we get to the actual questions, I want Tony to really introduce himself to everyone and to explain why I introduced him the way I did. Helping entrepreneurs realize their dreams is a dream come true for some of us. You know, being able to be in that spot where you tell them they're approved for a loan and that they can get their business off the ground, that's got to be a lot of fun working in business development like you do. And of course, on the other side of it, you've been doing mortgages forever and you still dabble in them even today. Helping people buy a home. The most important purchase anyone will ever make in their lifetime is usually buying a home. And to be a part of that, it's got to be special in some ways, even though it's been repetitive and you've done it so many times. So I'm going to give you a couple of minutes and please tell everyone about yourself.
Yeah, well, first off, Kim and Adam, thank you again for having me on today. And yeah, so I've had a bit of a crazy career. I've been in the tech world. I've been in the mortgage world, real estate. And a few years ago, me and my business partner, Greg, actually started a company called Appointments IQ, which does business development and, um, lead generation for small, medium-sized companies. And off that, we also started another company called Hubio or Hubio Mail, which is email marketing platform. So pretty much my entire career has revolved around a common theme, and that is, getting doors open and getting in front of decision makers, but also taking smart, fun, interesting people of all different walks of life and putting them in a room together and, helping them find a way to do business together and being that conduit that gets all these people, engaged and trying to get some value out there. Because one thing I know, like all of us are here in sales, we can agree that cold calling is not fun. It's probably our least favorite thing to do. And my workaround from avoiding that as much as possible is just hosting events, whether they're in person or virtual. I just get a lot of fun, interesting, smart, like-minded individuals and either get them in a bar together or get them in a Zoom room together, and we just exchange ideas
Hey,
and find
Tony,
ways to help each other out.
would you say that today's technology and technological advances have kind of made cold calling obsolete?
I mean, I don't feel, I'd say to some degree, yeah. I mean, cold calling still is a necessary evil for some people, but what it's definitely done is it's made it a lot easier. It's made it a lot less painful because, like with LinkedIn, case in point, like if I'm calling someone, most people I know in business are on LinkedIn. So I can look up someone's profile and I can see how long they've been at the company. I can see where they went to college, when they went to college, and also with Facebook and Instagram. I mean, there's so many different social media outlets that you can, look up somebody and kind of get a general feel for what they're all about before you even
Right.
pick up the phone and call them. So you kind of know what buttons to push and what angle to go on to get someone's attention. And
Definitely.
so,
That's what I meant when
yeah,
I said that. It's no
yeah,
longer a
yeah,
cold call per se.
yeah,
It's a
yeah.
cool call, but it's not a cold call. You're not going in blind. You have a lot more information than you used to.
And I
Oh,
think
exactly.
I think
I'm
with
sorry, Kim.
the situation that we're in right now, people have been able to take advantage of networking online and the technology that we have available. And I think networking actually got a little stronger because we're all stuck at home or stuck indoors in front of our computer. And that's our only option if we're going to stay in business, is to connect via the internet and through this technology.
Exactly. And something that's key to point out too is that, as I mentioned, I've been doing these big in-person events for over 3 years and just started doing the Zoom events in the last, I started doing them a few months ago, but it was around the time that spring and summer were kicking into gear in Chicago. So it was kind of hard to keep people engaged because we only get 4 months of nice weather here, not like you people in LA and Phoenix where you get nice weather most of the year. So that 4 month window of nice weather, people want to be outside socializing and having fun. They don't want to be indoors on their computer. So we started kicking these Zoom events into high gear the last few weeks. They've gone well because COVID going on, you got cold crappy weather in Chicago, so people got nothing better to do. But what it's really done though is it's streamlined the process, and also it's a 1 hour time investment. It's like
Mhm.
for someone to go to an event that I would do in downtown Chicago, it's like a 4 to 6 hour time investment because there's the time to get ready, drive there or take the train there, and then actually get to the event, park your car. Then the event's 3 hours long. Then usually people tend to hang out afterwards, and then you go home. I mean, so to go to one
There's
of my events,
also an
yeah.
expenditure in the live event, right? I mean, not
Oh yeah, yeah,
you buying a
yeah.
drink or two or a snack because you're there for so long. You end up spending a little
Oh
bit of
yeah,
money. And the online
yeah.
events, the only cost is
Exactly.
is coming out of your shell.
Exactly, exactly. So it's one of those things where there's definitely pros and cons to each thing. But one thing I've learned in business is that you're going to get so much crazy stuff thrown at you. And what you want to do is just adapt and find a way to make it work. There's always a solution. And, we can't control COVID. We can't control what's going on. So what we can control is ourselves, our attitude, and how we adapt to a situation, and just find creative ways to keep people engaged. And that's what these virtual events have been. And the beautiful part is that when we can do the in-person events in the near future, whenever that is, we're still building this audience. We're building this loyal following. And the great part is now it's expanding with the market. So, you know, sometime in the near future, we'll probably do some events in LA and Phoenix and Vegas and, in your neck of the woods, and we'll get a few hundred people together and
I
doing
promise
these
I'll be
virtual.
there for the event in Phoenix, and I
Yeah.
can promise that I will make my best effort to be there for any Vegas event. It's only a couple hours drive for me, so
Oh yeah, oh yeah. Well, I got the people in place to make it happen. I just need for this silly pandemic to end soon, so we can
would be nice.
put this all into motion. But in the meantime, we'll do these virtual events and keep things moving forward.
I mean,
You've done a great job.
I'm stuck in this pitch black room behind me here, and I'd love to see the sun again. It would be nice. I live
You're
in
in the
sunny
lion's
Phoenix.
cave today. The lion's cave,
Well, that
Adam.
lion is my friend. By the way, for those that don't know, that is the logo for U.S. Financial Alliance. All right, so we're going to get into our mailbag. We've had
Yeah,
lots
let's start.
of email. We have had more email than we've had viewers, which is amazing to me. That being said, Tony, we're going to pick your brain basically on new home buying because that's where most of the people who watch our show are at. They're planning to
Yep.
buy their new home, and you've been a mortgage broker, you've been someone who gets mortgage loans approved, and you've been the real estate person to help people look for houses also in the past. You've done both sides of the street. So we believe that you're going to have some very insightful answers for some of the questions we picked out. So you ready?
Yep, let's do it.
Let's do it. Kim, you want to throw the first
Awesome.
question?
I am. We heard from Jerry in Washington. His question was, how soon should I start getting myself financially ready to buy a home? I think this is perfect timing, this question.
Yeah, well, I'd say right off the bat, working with people with mortgages and credit and debt consolidation, all that fun stuff. The first thing is for someone to get their financial house in order, and I always tell people to kind of plan out at least kind of like 3 to 6 months, and in that 3 to 6 month period, if someone's not ready, something they should do is really figure out what they want to do. So the first thing is, how much house can you afford? I mean, it's like, someone might be able to buy a $200,000 house or $1 million house. So I guess that's the first thing is how much do you want to spend? And obviously, Phoenix, LA, Chicago, you got the actual cities, you got the suburbs, you got some suburbs that are nicer, some suburbs that are not as nice, some that are near all the action, some that are out in the boonies, So there's so many different factors that come into play of how much a house is going to cost, or a townhouse or a condo. So I guess the first thing is how much can someone afford? And then also getting their finances in order with their credit score, making sure there's enough money for a down payment, all the expenses, legal fees, closing costs, a lot of that stuff really adds up that people just don't think about. And then probably the biggest factor too is getting all the docs in order. So having, pay stubs and W-2s and tax returns and, bank statements, 401k, IRA, it's like there's just a lot of documentation that's involved in getting a mortgage too. So I always tell people, take some time to figure out what it's going to cost, how you're going to have your credit score, where it's going to be. And then also, looking at, websites like Bankrate and other sites where you can see what the interest rates are and what potential, mortgage programs would make the most sense for you. And then lastly, there's also homeowners insurance. That's another factor that comes into play. So I know I kind of give you a bit of a long-winded answer to this question, but the thing is, to get yourself ready to buy a home, I mean, it's a major ordeal. It's a major process. So I'd say take a few months and really get all your ducks in a row and just make sure you're ready to go. Because the other thing too, the last thing I'll say is, with these really crazy low interest rates we've had in 2020, the housing market's been just crazy and the refinance market's been really crazy. So what I recommend too is, when someone is house hunting and they're ready to do it, if you find a place that you like, be ready to make a bid, because there's probably like 10 other people that are going to bid on the same place. And if you wait too long, someone's going to grab it from you. So that's why you want to make sure you got all your ducks in a row, your financial documents, your credit score, money in the bank, everything ready to go, because once, especially when the spring market, because then it's go time. I mean, then it's
Mhm.
like you can't, goof around, because
Like
you'll
planning a
find a
wedding.
place you'll love. You'll find a place you'll love, and you blink, and then it's gone. So
Yep.
Yep, like I
Yep.
said, it's like planning a wedding. You have your venue, and all of a sudden, poof, somebody grabs it out from under you.
Yep. Yep.
exactly.
Go ahead,
Tony,
Kim.
I
You wanted to
love,
add?
yeah, Tony, I love that answer. And we're going to touch more on a lot of those points that you brought up. But one of the comments that you made, getting your financial house in order, I love
Yep.
that term. That is key.
Yeah.
And my recommendation would probably be anywhere from a year, starting a year before, because you need to know what's going on under that roof of your financial house. And
Oh,
one of the things
yeah.
that I promote in my credit consulting business is always know where your financial house stands. Know what your credit score is, know what you're working towards. If home ownership is one of your dreams or goals, make sure you're working towards that and putting the savings set aside, like you said, to have your down payment. Is it going to take, it's probably going to take more than a year to get that down payment where it needs to be, to get you to the rate that you want it to be, to get into the house that you want to have. And we'll get into all of those different things about getting the right house that fits your budget as well. So I would say anywhere from a year at least in advance to be financially ready. But I love the term
Yep.
financial house in order.
I do
Yep.
too, and I'll add my 2 cents. Jerry, it's an excellent question because it really depends on where you're home buying. Tony kind of touched on that a little bit. If you're buying in the suburbs of, say, Missouri, it's going to be a little easier to find your house than if you're buying in the city of LA.
Mhm.
But I don't want to get into that. I believe 6 months to a year is the reasonable amount of time. That's just my personal opinion from what I've seen. But there is nothing more important than deciding in advance, do you want to apply for your home loan first and get approved for an amount? Or do you want to find your home first and then try to get the loan for the amount of the home you want? I personally recommend the former. Go to your bank, get yourself approved for what you have, and then shop for your home based on your budget. You will end up with more house most of the time than you thought you would, but at least you know in advance what your budget looks like. And that's just my 2 cents on the matter. Tony, that was an excellent answer, by the way.
Yeah, and well, thank you. And just to add a little bit more to that, something you mentioned, Adam, is that I obviously network with a lot of real estate agents, not just in Chicago but all across the country, because I working for a federally chartered bank. I can do loans in all 50 states, and one of the common themes too is that all my real estate agents I partner with, it's like most of them will not even spend a second talking to someone until they're pre-approved first.
Mhm.
Because the last thing someone wants to do is get someone in their car and show them a whole bunch of places and get all excited thinking, okay, I'm going to sell this person a house, or this person where you go, and then turn around and run their credit report or go through stuff and realize that they got some skeletons in their closet and they don't even qualify, they can't even buy the
Mhm.
place. Then that real estate just wasted a whole day showing someone all
Sure.
these homes.
Sure. And
so
worst of
so I
all,
think that's a key.
the home buyer is going to
Yeah.
be so depressed at the end of this,
Yep.
thinking
Yeah.
they were all
Yeah.
set. They looked at these houses, they chose the one they loved out of the three or four they looked
Yeah.
at. And then the bank says,
Yeah.
well, no, we can't even approve you for half of that. I mean,
Yeah.
it's always best to
Yeah.
get pre-approved for your loan in advance if
Exactly.
you
Mhm.
can, because
Mhm.
then at least you go into this with your eyes wide open, and your
Yep.
financial house is more in order automatically because you already know what your
Exactly.
mortgage payments are going to look like with the insurance added in.
Exactly.
Yep.
Yep.
So
100%.
that's
Great input.
just my 2 cents. I get to throw the next question out, and Kim, you'll go first this time.
All righty.
So we have Robert out in Texas, and remember, Kim, don't mess with Texas. What should my credit score be when trying to buy a house?
Well, it really depends on what type of loan you are going to need to buy this house. For conventional loans, I believe it's a 620 that you need, but there are programs that you can have a lower FICO score, but you're going to get your best interest rates when you're up in the 740 range, obviously. But it's not just the credit score that's going to be looked at, and that needs to be mentioned as well. Just because you have a 750 credit score and you're making $50,000 a year does not mean you will qualify to buy that $1 million home. So
Exactly.
it's a good point to look at your credit score, but that is not the end all be all determining factor as to whether or not you're going to get approved for a mortgage.
Credit score is just a piece of it. So I'll pick up the ball. We'll let Tony anchor this one. We had Isa appear on last week's show, and it was brief and it was wonderful because it applies right now, right here. I could have a 750 or 800 credit score because I have 3 credit cards, one with Target, one with Macy's, and one with JCPenney's, and each one has a $300 credit limit, and I'm spending $10 on each of them. I have an 800 credit score because I'm using much less of my credit than is available. I have no late payments. I have a perfect history. So my score will be really way up there. But when they look at me for a mortgage, they're going to say, well, you only control $900 worth of credit. So even if you went out and went hog wild and maxed out all your cards, 2 weeks pay would cover the debt you've built up. And therefore, you're not a worthy credit risk. And they're going to ask me to go through the FHA approval process for first-time home buyers that are not necessarily as credit worthy. Now, there are benefits to that. Don't get me wrong. And I'm sure Tony will touch on that when I pass the ball to him. There are benefits to that, but there's a bigger benefit to having your whole credit profile in order, not just your score. So I'm glad you asked about score, but remember that score is one piece of a 5-piece puzzle.
Right.
And with that, I'll give it to the expert.
Oh yeah, thank you, Noah, and Kim and Adam. No, you both great answers. You definitely touched on key points there, and yeah. So as far as credit score goes, I mean, a general rule of thumb is that yeah, if someone has a credit score like in the mid 700s and higher, then that's ideal because then you're going to be able to take advantage of these ridiculously historically low interest rates that we have going on right now that are probably going to stick around for a while. I don't see them going up anytime soon. And if they do, it'll probably go up a little bit. So yeah, so anybody out there is looking to buy a home, whatever you can do to do everything you can to get your financial house in order, but then also have your credit score of 750 or higher, that's going to be great. But depending on which kind of loan you get, yeah, the scores coincide. So a conventional loan, as Kim attested to earlier, which is the most common loan out there, that's 620 score is pretty much the minimum there. And then there's also jumbo loans, which are loans that are going to be like over $500,000 or more. So that's someone buying a bigger place or taking a bigger loan. Right now the credit score you need to qualify for a jumbo loan is around 680. And then you got the different government loans, the FHA, VA loan, USDA loans. And what's interesting about those is with the FHA loan, which is very common for first-time home buyers, generally they got to be in the 500s. But the thing is that if someone has 10% down, they can have a score as low as 500 to qualify. But if someone is only going to put down 3.5%, which is the lowest you could put down, then they got to have at least a 580 credit score. So it's kind of a little bit of a sliding scale there. And then with VA and USDA loans, those are also government loans, but they actually don't have a minimum credit score. But generally, when you go through lenders, a VA loan, they want to be 620 or higher. USDA loans, which are more for people buying places in rural environments, they're going to want to have a credit score like 640 or higher. But as Kim and Adam, you both mentioned before, credit scores is one piece of the puzzle. I mean, it's not the be-all end-all, but it is a very key indicator of someone's, credit worthiness and ability to take on the mortgage and be able to make their payments on time.
Thank you, Tony. Excellent. Excellent. We're getting some real information out there. I didn't even realize I had forgotten all about USDA loans. They don't happen where I happen to live very often, except way upstate here in Arizona. And I come from New York City, where they're almost New York State, yes, but New York City, you're not going to see one of those.
No.
All right. So, Kim, you get to throw the next one.
I will. Let's see. Kathy in New York, she has a great question. Where do I go for the best financial options to buy a home? Do I start at a bank, a lender, and what's the difference? I'll start.
Go ahead.
Yeah.
Well,
This is a big question.
yeah, it's definitely a big question, and um, probably the best starting point is to know the different options. So when you go to your bank, they might not have all of the different programs available. They're just going to offer what your bank offers. But depending on what your situation is and the relationship you have with your bank, that may be a good option for you. But mortgage lenders definitely have more options available to you and more programs to try to find the best option based on your situation. What's your intake on
Go
that,
ahead, Tony. You're up.
Tony?
Yeah, so definitely there's quite a few different things, but I guess also before someone decides which route to go, the other factor to consider is, how long does someone want to live in the home? Is someone looking to live there just for a few years and they might move, or is someone looking to plant the roots and live there for a long time? So that could affect which kind of loan you want to get and which route you want to go. But as far as banks versus lenders go, is that you're right, Kim, is that if you have a bank, there's going to be not as many options. And also, and I feel bad because I work for a bank, but sometimes going through a bank, sometimes the uh, process or all the paperwork, sometimes it takes a little bit longer. Sometimes a couple extra set of hands that the paperwork goes through. But one thing, though, with a bank that could be advantageous, especially if someone's getting a jumbo loan. So, like, let's say someone's like a doctor or they're I don't know, professional athlete or whoever they are, where they tend to make more money than the average person out there. Going through a bank will be a good option because then they can get a jumbo loan. Where a lot of banks will do is say, "Hey, tell you what, do your checking with us, do your saving with us, get some of these other banking programs with us, and then they can, get them a better interest rate, to do a
Reduce their
loan with us."
fees also, I believe. They'll cut
Exactly.
them a
So
break on closing costs and other fees.
exactly. So thing is that whether someone goes to a bank or goes to a mortgage, lending service, or whether they do a credit union, that's another option too. I mean, there's different pros and cons to each, but it really depends on what someone's situation is and what's going to be the best fit for them. But at the end of the day, though, the key thing is, having the money for the down payment, having the credit score is, having the DTI, the debt to income ratio, below 40%. I mean, there's a lot of different things that come into play. But in general, though, yeah, banks could have not as many options. But if it's a bank you got a long term relationship with, you could probably get a little more flexibility to do things. Whereas the mortgage company, you're going to have a lot more programs to pick and choose from. And also you might, be able to have a little bit more ways you could do something that a bank might not be able to do. So I guess the best way to answer that is it depends, what your situation is, what's going to make the most sense for you. But the beautiful thing is we live in a country where you have options. It's just a matter of finding the best one for you.
Mm-hmm.
Okay, I don't have much to add. I'm stymied. You just answered
That never
everything.
happens.
Sorry,
Never
I did.
happens.
Sorry,
No,
I
no,
didn't,
no.
I
It's
didn't
a
mean to steal your
wonderful thing.
thunder.
There is no. There is one thing I can. I always have at least one tip or trick in my pocket. There are plenty of online groups and online support for a first-time home buyer, for someone who's shopping for a home who's not used to the process. And joining one of those groups, you can get a lot of good advice absolutely free. There are also a lot of nonprofits out there who are not looking to sell you a loan, but just want to explain the differences, the intricacies that Tony, myself, and Kim have studied for years to understand the differences in the types of loans, whether your loan is a governmental loan, a bank loan, a credit union loan, a mortgage lending institution loan. They all, like you said, Tony, have their benefits and their drawbacks, and they're all available to most home buyers. And so you really want to understand them. And the best way to do that is get someone who understands them completely to go over the good parts and bad parts of each with you. So I'll leave it at that. And I have a new question to throw out. We're up to question 4. And this one, I love this one. This is from Terry out in Kansas. What factors do lenders look at when approving a home loan?
Oh, wow. It's okay if I jump on this one first?
Oh, definitely.
Please
Okay,
do.
cool. So the beautiful part is we actually covered quite a bit of this from previous questions, but But really, I mean, I guess of all the main categories is, obviously, the credit score and credit history is a major factor.
Wait, you mean it's not height, weight, and eye color?
Blood type,
There you go.
your horoscope, your zodiac sign. If you like long walks on the beach. But then also, your debt income. How much money do you have in your household? What kind of debt do you have out there? And the income itself is how steady is it? It's like, especially in this day and age, I mean, most people I work with are, husband and wife that are buying a place together, and quite often the mortgage will be under the husband and the wife. So that comes into play of not just one credit score, but like two credit scores, and how much debt they have out there, what kind of payments they got with their different loans they have for like cars and other things, and also their jobs, like how long they've been in their jobs for, and have they what are W-2s from the last couple of years. I mean, so there's so many different factors that come into play, but at the end of the day, it's all about, credit worthiness, income, and debt to income ratio, and what kind of history they have, and just making sure that this is someone who's going to pay the loan in a timely fashion, not going to default and
Mhm.
have to be foreclosed on. So that's really what happens is with the mortgage world. It's basically take all this data, we pretty much throw it into a process, and then it kind of spits out this information that basically says, yes, this person qualifies, or no, they do not. And if someone does not qualify, then it's okay, what are the areas that need improvement that maybe they don't qualify now, but we could work with someone for a few months and get them to work on a few things where they can qualify, in the near future.
Excellent.
Excellent information.
All
And
right, Kim, you're
um,
up.
yep, basically it's when your loan goes to an underwriter, they're determining what type of risk that borrower is. Like you
Mhm.
said, the bank is not looking for somebody that they're going to have to foreclose on. They want somebody that is going to be taking this loan to its maturity, whether that be 15 years, 30 years, or however long it is. They want to look at the credit worthiness of this person, and they want the minimal risk as possible. And that also includes everything that Tony mentioned, as well as the down payment. How much have they saved for this investment? They want to see how much skin do they have in the game. Is this something that they're going to invest in and take pride of ownership in? Or is this going to be an investment where if it doesn't work out, they're just going to walk away? That's obviously a higher risk, therefore a higher interest rate as well. So overall, it's taking a look at the risk of that borrower.
All right. So,
Take it away, Adam. Bring it
yep.
home.
I'm going to bring it home by saying this. I'm wearing a blue collar, so I'm going to give the blue collar answer. Okay. So, Terry, here's the thing. You want to prove to the bank more than you can, more than you're able to, that you don't need the loan. The more you can prove to a bank you don't need the loan, the more anxious the bank will be to give it to you.
Yep.
So, as Tony said, you want to have a very, very good debt to income ratio. You want your income to be 3 or 4 times the amount outgoing, if possible. You want your scores to be 660 and up. If you hit 680, you're in the best possible position for a good mortgage loan. These are the things I know from my history of working in the industry. I've never been a mortgage lender, but I've worked for a few, and I've worked with a few others. You also want to make sure that you're not over leveraged. If you know, I had mentioned leveraging when I mentioned our current president in our last episode. I'm not even going to bring up his name, but he's over leveraged at the moment, which is brought up in a lot of articles. He's over leveraged. He's worth plenty of money, don't get me wrong, and everyone knows that he will end up paying whatever he owes, but he owes so much that banks don't want to touch him to give him loans right now because of leverage. And that leverage translates into the DTI and into that blender that spits out the information Tony was talking about.
Yeah.
What they're looking for is, are you leveraged? You want to be as unencumbered as possible when you go into buying. And you also want to save up as much as you can. The higher your down payment, the more the bank knows that you're serious. That'll be my final part. Tony, we're going to throw the last question straight at you.
This
Uh,
this is a fun question,
okay.
and it comes from Allison in Nevada. Will a cosigner help me get approved?
Wow. So that's a great question. So once again, depends. It depends on the situation because
I wear those. No, 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 no.
that's awesome. So
We like to have fun here because
oh
it's so
yeah,
serious. If you don't break the monotony of the seriousness, I
yeah.
mean, a home purchase is a 30-year loan
Oh
most
yeah,
of the time.
This is
Sometimes it's
long term.
15, but
yeah,
30 years of your life. Just imagine. Remember when you were born and you were a little kid, and then remember what life was like at age 30. Okay,
yep,
a lot changes over 30 years.
Yep.
And that kind of commitment, I mean, a lot of people don't even have that kind of commitment with their spouse, for God's sakes.
oh yeah,
So if we don't make a little joke here and there, and we don't break
yeah,
the levity, it gets too serious. And I don't want people tuning out just because this is more than they can handle. So every
exactly.
now and then I do throw in that joke, and I've worn it depends on a long hike once or twice, but and we'll leave it at that. Go ahead, Tony. This one's all yours. Talk about cosigners because it's a tricky thing.
Yeah, so I think the biggest factor when it comes to co-signing is it comes down to trust. That's the biggest factor out of all this because at the end of the day, when someone is asking another person to co-sign a loan for them, that's a major, huge ask of someone because that person is putting a lot of trust in the other person because if so for example if I were to at a younger time go to my parents and get a cosign for a loan and a year into it I lose my job or I just decide I don't want to pay it or just something happens where I don't partake in it anymore, then they're on the hook, and then their credit score is going to get compromised and their financial world can get devastated. So really what it comes down to is having someone co-sign for a loan can be a very good positive experience, provided that the person who's co-signing, their financial house is in order and is pretty strong, and that the person that they're co-signing with is a trustworthy, reliable person who's not going to flake on them and leave them in a lurch with all this debt. So I personally am not the biggest fan of people co-signing loans unless it's a rock solid relationship and there's a long history there and they know they're not going to, you know, compromise the situation and make it worse. Uh so yes, the answer to the question, yes, it can be done and it has worked very well for some people, but the flip side, I mean, just personal experience of being in the mortgage world, I've seen co-signing go sideways way more often than go positive. So
That's what I've
let
seen in the
yeah,
debt
unless it's a
relief
rock
industry.
solid, relationship and situation, I think that someone who's looking for a co-signer should just focus on getting their stuff in order first and then do it. Because like I said, I've just seen it go in a bad situation far more often than I've seen it work out well. That's just my personal experience of what I've seen in doing mortgages.
I would have to agree with you, Tony, that that relationship and the trust factor really has to be there. And you need to take a step back and look at, why does somebody need a cosigner? Do they need a cosigner because their credit isn't strong enough? Well, that's already a red flag. Why isn't your credit strong enough? And what's the reason that's bringing down your credit score? The other thing is, do you need a cosigner because your income isn't high enough? And if the person that wants to buy this house, their income isn't where it should be, that's also another red flag. Are you looking at a house that you cannot afford? Because that's the whole reason you need a cosigner, is to bring their income to lower that debt to income ratio. So lenders are still going to look at the lowest score uh, of the applicants, and that's still going to be a determining factor. But
Oh, yeah.
a cosigner, definitely you have to take a look at that relationship that the borrowers have.
Okay, I'm going to give a little twist on this. I'm not going to approach it from the direction both of you did. There are two types of cosigners in my world. I come from the debt relief world. There are the cosigners who are going to be living in the property and the cosigners who are not going to be living in the property. I
Mhm.
recommend the first. I don't recommend the second. Okay, so husband and wife
Agreed.
co-signing makes sense. They're both going to be
Yes.
living in the property.
Yes.
Elderly parent, younger, 30-year-old child, they're both going to be living in the property. The elderly person taking the apartment downstairs or whatever the case may be, and the rest of the house run by the child and the family.
Yep.
Again, perfectly fine to have, especially, and I won't exactly get into why, but it's incredibly good if you have somebody who's older co-signing for you. There's a longer credit history there,
Right.
which actually the history might mean more than the score when it comes to a mortgage.
Mhm.
History is a bigger part than even the utilization when it comes to a mortgage. History takes precedence.
Yep.
So, that could actually work out well. Now, your best friend that you went to high school with and grew up with and hung out with, and you went to each other's weddings, you were each other's best men, et cetera, et cetera. The best way to end a friendship is to ask them to co-sign for a loan.
Oh, yeah.
Because remember, I told you this in episode 1. I'm a strong believer in life happens, and it will happen to you. There's no
Mhm.
doubt about that. Life happens to all of us. When I say
Mhm.
life happens, it's not a bad thing. Don't connotate it with a bad thing. When I made this example once before, my wedding day was life happening, and it was the happiest day of my entire life. But then, of course, my losing my job at any place that I've ever worked, or my losing money in the stock market, or a cyber problem where there was some identity theft, and all of a sudden I have no funds in my bank account, and it's going to be 8 weeks before they return them to me after an investigation. Life happens. And
Yep.
now, when life happens to you, your best friend of 30 years, his credit gets totally wrecked in the process. And he's not the person who suffered the identity theft or the loss of job. And so, through no fault of his own, he could go from a 750 to a 600, and it could affect a lot of things, from his insurance rates to his housing insurance rates to all of his loans. Universal default means his interest rates on every loan he has can go up.
Right.
So that's the approach I take is, are they going to be living in the property? Because if you're living in the property, you're going to do everything possible not to not have a roof over your head. And
Exactly.
therefore, you're going
Mhm.
to take it more seriously than someone who is not living in the property. So, from the debt relief angle only, what you both said is completely true of 99% of home buyers. But from the debt relief angle, co-signers should be someone who are going to either be living or investing in the home.
Excellent take on that.
Thank you.
That's
I try.
and you do a fabulous job. Great information, and we've had great information the entire time. And I know
That's
that
because we've had a great
provided.
guest.
We do have a great guest, Tony. You've been awesome.
Oh, you two are too nice.
No,
Thank you. No,
you're too modest. That's the problem.
no, no, you've been phenomenal hosts. I really appreciate you having me on, and this was good. But also, what's cool is I learned a few things too. So this is really good. We get like-minded individuals together, and we talk and bounce things off each other. We're gonna learn some new stuff in the process, which is great.
No, it's a point of view thing. And Kim comes from the point of view of credit and credit repair and credit consulting. I come from the point of view of debt and debt relief. And you come from the point of view of giving out the loan. So when we put those three things together, we get a very wide approach to how things are going to work best for different types of individuals, which is why we couldn't wait to have you on. And I want to announce right now the co-owner, my partner, Isa Israel, who's been a guest in spots. We've quoted him a few times here, and we've had him on for like 30 seconds in our last podcast. But he's going to be our guest next week, talking about personal loans instead of
Mhm.
home loans. He is a personal loan specialist, so we're going to have him in the hot seat where you are now, Tony, next week.
Nice.
So, we have a lot of great guests coming up right after New Year's. We have a bankruptcy attorney who's going to sit with us to go over from the attorney side how bankruptcy works. We've already covered it once. We have an entrepreneur from Texas who has started 4 of his own companies. He's currently working on his 5th, a brand new social marketing campaign. His name's Daniel Zatarain. He'll be joining us. I have Samantha Demchak, who is an administrator of a senior living facility out in Oregon. She'll be joining us to talk about the tough road of finance for seniors living on fixed incomes and not living in their own home anymore. Finances get very, very cloudy when you're not in total control of them anymore. And that's what happens to seniors in assisted living facilities. Their income is taken by the facility before they even get to see it. And so she's going to talk about that and how seniors can budget and plan when they're living in assisted living. So we have a lot of great guests. There's Angel Cerna, which is
Angel, yep.
one of Kim's friends, who is just an amazing person and a wealth of information the way Tony is. Can't wait to get him in that hot seat. I want to pick his brain just so I can expand my business.
Yep, that's what he does. He does startup consultations. And then we also have, we're going to talk to a couple people tonight at the networking event, somebody that does life insurance and investments. So that'll be another really great topic. And the timing of this is absolutely perfect. People are going to be cruising into a better financial future in 2021, and we're going to help them get there. So,
well, wait a minute. If we're going to be cruising through 2021, we're going to need gas. And the way this works is simple. For us to have the gas to keep all this information flowing to all of you, I need you to click like, and I need you to click subscribe, and I need you to make some comments and tell us what you want to see. We will do shows on what you request. You can send your ideas and any questions you have to questions@cruisingintoabetterfinancialfuture.com. That's questions@cruisin, CRUZIN, cruisingintoabetterfinancialfuture.com. As you see, we pick 5 questions every single week. We answer them in detail with our expert. In this case, it was Tony Paolella, and it was amazing to have his expertise on display. Next week, it'll be Isa Israel, and we'll just keep going from there. I do, Kim, surprise, surprise, I won't name names. We do have some celebrity guests that are this close to booking with us. So we might have some celebrity guests who know a little bit about finance. Some of them know a lot about finance. I've even talked to some of my old comedian friends who've done pieces on debt and finance in their acts because they've lived through it. And I'd love to have them come and just talk about what made them sit down and write this whole thing, this whole comedy routine on debt.
That would be so much fun. And I love the way that I tossed that ball to you and you just slammed it out of the park. That's why this works out so well. And I love the information that we're giving. So whether you are in the market to buy a home or you're just starting out the process, I know we've given you a wealth of information, and we've kind of hit it from all different angles. We've talked about mainly getting your financial house in order before you take that step to go out looking for that house of your dreams. Get your financial house in order, know what's under your roof. And so many people talk about the home buying process being so stressful and such a nightmare, and you wouldn't wish this on your worst enemy. But if your house is in order, it's going to be a lot easier if you know what you're dealing with.
This is very, very true. And I just want to say, for those of you who need a maid to help you get your house in order, that's what Kim and I and Tony in our businesses are all there for.
Yep.
Give any one of us a call. You've seen our company names. Our phone numbers are listed. I'm not going to go and plug them right on the screen. Kim is pointing at her website. You can find her there. You can find me at usfinancialalliance.com. Tony, where's the best place for people to find you besides the Loop?
Wow, there's so many ways. I'd say probably the easiest thing to do would be just to go to LinkedIn or Facebook and look up Tony Paolella, T-O-N-Y, and then P-A-O-L-E-L-L-A. I have my LinkedIn profile's got all my companies on there, and then my Facebook and Instagram, I got several different pages and profiles for all different things that I do, but I got a kind of a unique name, so it'll be easy to find. And then what I'll do too is I'll make sure to get you my info that you can put into this video when you post it. You can have my information down below, and people can click on the links there too. But,
I will include when I post when this video gets posted.
Yep.
We will make sure to include your basics. I promise, including links to your Instagram, your LinkedIn, and your Facebook, which I have personally. I love going to your Facebook. There's always a new event to sign up for. It's great.
Oh yeah, and then 2021, there's a lot more coming. So just get ready, get your seatbelts on.
Hint, hint, Kim, don't go to Tony's Facebook unless you want to register for things, because there's things to register for everywhere on there. It's amazing.
Yeah.
I registered
Yes.
for the $30 billion giveaway. Unfortunately, I found out it was a scam, so I took my name off the list. Well, everybody, that's pretty much this week's episode. We look forward to seeing you next week when our guest will be Isa Israel. Tony, it's been a pleasure having you. We were so glad you were able to make time for us today. But here's the fun part. In a couple hours, we're going to see you again.
Exactly. And we're all going to hang out. You're going to introduce you to probably like 20 or 30 new friends, because I looked at the lineup for tonight and it's a lot of new fresh faces. So get ready. It's going to be cool. It's not going to be, I mean, there'll be probably like 10 or 15 familiar faces, another 30 brand new faces. So
excellent. And I heard that the guest of honor tonight is someone I have a lot of respect for and is one of your business partners.
Yeah. Shayna's got another business venture, so she's gonna be talking about that tonight. She's gonna be
Very cool.
the featured guest tonight. So we're all taking
I love her
turns.
to death. She's an incredible speaker.
That's fantastic. And I even have a friend of mine that's attending specifically to see Shayna. So I'm looking forward to that.
Awesome. Very cool.
In fact,
very cool.
Isa will be there tonight. Even though he has surgery tomorrow, he said he wouldn't miss it.
Wow.
Okay, awesome.
He's a trooper.
Well, can't wait.
All right.
Well, thanks again, everybody. This is awesome, and we'll be definitely doing more of these, and I'll be helping to promote to my networks and get your viewership. We'll get those numbers up for you.
Oh, I expect they're going to grow, and I really appreciate anything you can do to help with that. But until next week, let's all keep cruising into a better financial future.
Thank you, everyone, for joining us. See you next week.
Great. Thank
Merry
you. Bye-bye.
Christmas, everybody.
Merry
Happy
Christmas.
holidays.
Bye-bye.
Thank you for being a part of Cruising into a Better Financial Future. Don't forget to hit subscribe so you don't miss a future episode. We'll see you next time. Bye.